Hey there, and welcome. Ever feel like the world of business is speaking a language you just don't quite get? Well, today we're going to pull that curtain all the way back. And we're not just talking about boring spreadsheets. We are going to learn the secret universal language that powers every single business on this planet. Let's get into it and crack this code together.
So, what do you think? It's a fun question, right? On one hand, you've got a global giant, and on the other, a neighborhood startup. But the answer is actually really simple, and it's incredibly powerful. They both speak the exact same language, and that language is accounting. It's the code that translates every single action, every sale, and every decision into a story that anyone, anywhere, can understand.
Okay, so before we start learning the words and the grammar, we really need to get a handle on the why. This first part is all about the philosophy behind the language. It's about creating a system built on trust and clarity, so that when a business talks to an investor, or even just another business, everyone's reading from the exact same dictionary. I mean, think about it like this. Any language needs grammar to make sense, right? Without it, you just have a jumble of random words. Well, accounting principles are the grammar of business. They are the agreed-upon rules of the road that make sure everyone is reporting their financial story in a consistent and, most importantly, understandable way. And not just any rule can make the cut. To become a core principle, a rule has to pass three really important tests. First, it's got to be relevant. It has to actually help people make real decisions. Second, it must be objective, meaning it's based on cold, hard facts, not somebody's feelings. And finally, it has to be feasible. You shouldn't need a supercomputer to figure it out. So in short, it has to be simple, logical, and useful. So, with the why firmly in place, let's build on that with the logic. These are the core assumptions that everyone just agrees on before a single number even gets written down. These are the foundational beliefs that the entire system is built on. Now, I know this might look a little complex at first glance, but it's a great map that shows how a few core ideas become the building blocks for everything else. We're going to zoom in on two of the most important ones, branching out here: the separate entity concept and the dual aspect concept. If you can master these two, you've pretty much mastered the bedrock of all accounting. First up is this idea that a business is its own person. Seriously, it is legally and financially completely separate from its owner. So if the owner takes money out of the business for a personal vacation, that's not a business expense. Nope, it's a withdrawal. The business's financial story is totally separate from the owner's story, and that separation is absolutely key to understanding the true health of the business. And then there's this concept of perfect balance. I want you to picture a financial seesaw. For every single action, there's an equal and opposite reaction that keeps that seesaw perfectly level, always. If something comes in, something else of equal value has to go out or change form. Nothing just happens in a vacuum. This is what ensures the financial story is always complete and always in perfect equilibrium. Now, this beautiful idea of perfect balance is captured in one single elegant mathematical sentence: the accounting equation. It simply states that everything a business owns, its assets, must always equal what it owes, which are its liabilities plus the owner's funds. Every single transaction, every report, everything comes back to this one simple, unbreakable rule. All right. We've got the philosophy, we've got the logic. Now it's time to learn the vocabulary. Believe it or not, all of accounting boils down to just 3 types of accounts, and each one has its own golden rule. This is where the theory really hits the road. First up, we have personal accounts. This is pretty straightforward. These accounts are all about keeping track of the people, the companies, and the institutions the business deals with. So think customers, suppliers, banks, basically any person or entity that you owe money to or that owes money to you. And here is its golden rule. For any transaction that involves a person or an entity, it's this simple: debit the receiver and credit the giver. Let's see exactly how that works in the real world. Okay, let's apply the rule. The business pays $20,000 to Hari. So who's the receiver here? Hari is. So we debit Hari's account. Simple. And what did the business give away? It gave cash. So we credit the cash account. Debit the receiver, credit the giver. See? It works perfectly. Next on the list, we've got real accounts. This category is for all the things the business owns, its assets. This includes tangible stuff you can actually touch, like cash, furniture, machinery, but also intangible things like patents. Basically, if the business owns it and it has a monetary value, it's a real account. The golden rule for real accounts is all about tracking the movement of these assets, and it is incredibly intuitive. If an asset comes into the business, you debit it. If an asset goes out of the business, you credit it. Simple as that. And here's that rule in action. Let's say the business buys furniture for $10,000. Okay, what comes in? The furniture, so we debit the furniture account. What goes out? The cash, so we credit the cash account. Debit what comes in, credit what goes out. It just clicks, doesn't it? Our final category is what we call nominal accounts. Now, these don't track people or things, they track performance. This is where we record all the expenses and losses and all the incomes and gains to figure out how well the company is actually doing financially.
And the final golden rule is the absolute key to telling that performance story. All the bad stuff, the expenses and the losses, they get debited. All the good stuff, the incomes and the gains, they get credited. This is literally how you calculate profit or loss.
Okay, let's lock this whole thing in with one last example. The business pays $20,000 in salaries. Now, a salary is an expense, right? So we follow the rule, debit all expenses. That means the salary account is debited. And what went out? Cash. And we already know from our second rule that when the asset of cash goes out, the cash account gets credited. You see how all the rules just work together? Every little piece fits perfectly into the bigger puzzle.
And just like that, you've done it. You have the fundamental tools. You get the why, the principles of trust. You get the logic, the core assumptions of balance and separation. And now you know the vocabulary, the 3 types of accounts and their golden rules. You have officially cracked the code.
So I'll just leave you with this one thought. This stuff isn't just for big corporations. This is a language you can use to understand any financial story. And that includes your own. Whether it's a side hustle you're thinking about, your personal budget, or your next big idea, now that you know the language, what story does your money tell?